Chris Clothier bringing you another video from the grind powered by REI Nation. And today it's timely. I wanted to record a video as fast as possible about what's happening with the Fed. The latest interest rate, historical rise in interest rates. The first time the Fed has raised interest rates by 0.75 of a point or more 4 consecutive times. They lined us up for another 0.75 point raise in December, so it could be for a 5th time, possibly just a 0.5 point raise, but it's pretty universal across most economists. They believe that rates are going to be rising again. So you'll have this historical pace at which the Fed is raising rates. What has that done to the housing market, and what should you do as an investor? That's what I'm going to attempt to answer in this short, quick 5-6 minute video. And look, I'm going to keep it really high level just so you guys understand. We can dig in deeper, ask me questions in the comments. Happy to go into it with you. But here's the bottom line. What does the Fed raising rates mean? Well, it means that there's a possibility that mortgage rates are going to continue to go up. There's a lot more that goes into the mortgage market than the Fed rate. In fact, the Fed rate does not have a correlation directly to the mortgage market, but it's highly influential. What it means, no matter what, no matter how you look at it, it means that your borrowing dollar buys you less. It means that your dollar's worth less. It means that you're losing buying power literally every day. So the longer we wait as investors to actually do something with our cash, the less stuff our cash can buy. I don't care what you think about the real estate market or what you think about anything. Right now, if you're sitting in cash, you need to stop. You need to get your cash deployed, preferably into a product. That's why I love real estate so much, that you can borrow against, so you can leverage to buy something more valuable and something that historically goes up in value. That would be the housing market. It's the only thing you can borrow that historically goes up. Okay, so that's number one. You're losing buying power. That's what the Fed rate raising means. The Fed is going to raise rates again, most likely in December. They made some signals that they're going to start cooling the interest rate raises early next year. Possibly by the first quarter, second quarter, we're beginning to see rates come down. They're going to lower the borrowing rates to try and spur the economy back in and try and find that middle balance. That's fantastic. That would be great. Again, that doesn't mean mortgage rates are going to come down. It just means that your dollar will gain more buying power at some point in the future. Right now, it's losing it. Get your dollars in. The nice thing, what goes down or what goes up must come down. These are the rates. Historically, rates go peak, trough. So you will see rates reach a peak to try and cool off the economy, cool down the buying. Then they will start to come back down as they want to ramp up and heat up our buying. So be on the lookout. No matter what rate you lock in today, you will have an opportunity in the future to renegotiate or to refinance. If you are buying for long-term buy and hold, buying turnkey properties, for instance, and you're going to hold these for the foreseeable future, 5, 7, 10 years, you will have a chance to refinance whatever you get your money in today. My advice, get your money in, collect assets that go up in value, okay? Borrow. Don't over leverage, but use leverage to be able to accumulate as many assets as possible at the best rate you can get. Because in the future, when it goes up in value, you will be able to refinance at a lower rate, reduce your costs, and if you don't take money out, now it costs you less to own that higher value property. That's why you get in today. Time in market is so much better than timing the market. Trust me. All right. Redfin, the CEO of Redfin, Glenn Kelman, recently said, and I want you to pay attention to this, that iBuyers and home builders have the inventory. They have a majority of the inventory that's out there for sale today. iBuyers and home builders, two groups that have the money and the incentive to sell off their properties as fast as possible. That is why you're seeing this historic downturn in pricing on downturns in home values happening as quickly as it is in some markets around the country. Some markets are seeing no downplay at all. Some are just seeing like a half a point to 1 percentage point year over year decline. That's nothing. And even the markets that are coming down historically fast, they're still coming down at rates that means anybody that bought in the last 5 years has made an incredible amount of money. They're still not coming down greater than so far 5-6% in any one particular up-end market. But here's why. Because that's where the iBuyers and the home builders are. You're talking about West Coast, you're talking about Vegas, Phoenix, of course, San Francisco, LA. They're coming down fast because the iBuyers are quick to sell. He even said it yesterday that, there is something worse than having your own money in real estate while real estate is going down. It is to have somebody else's money. So borrowed money. Companies, all these iBuyers, like a Redfin, like a Zillow, like Open Door, they have shareholder money in there. They have money that they have leveraged to be able to buy real estate. They were never meant to hold real estate long term. They don't have these houses rented. They're looking to sell them. So what they're doing is finding the lowest price, going 2 points below it, and dumping everything they can as fast as possible. You're going to see prices come down without this sudden explosion of new houses available. Because anybody that bought in the last 5 years, they're priced out of the current market just by the rate alone. They're not selling their house. So, and then when you do see home sellers begin to sell their house, number one, the biggest question is, where am I going to go? They don't have any place to go. There's no inventory out there. Those that decide to chance it, they're going to sell their house. Who are the biggest buyers right now? Well, it's not the iBuyers because they're out, but institutional investors are a presence that was not here over the past or the previous decade. Certainly the last housing crash, they didn't exist. Blackstone is a massive buyer today. They are buying up a ton of properties along with other companies like them that are these big institutional investors that want to own the homes. They want to own as many homes as possible. They're buying entire neighborhoods from home builders because they're banking on, as long as rates are high, the biggest group of home buyers in America is the millennial group. And they are not going to be buying in. They're priced out at 7.5%. Okay. So they're looking to rent until rates come down. So as I'm looking at the market right now, what does the Fed's push up mean yesterday and what should you be doing? To me, I still believe fundamentally in the real estate markets, especially across the Southeast where I happen to be. That's why I'm investing here. We're in 12 different markets across the Southeast. This is where you're going to make money. This is where you buy property. It will go up in value. You will see strong rental demand. And anything that an investor is buying today, you will continue to reap the benefit of as you go forward because you will have locked in your dollar, buying the best value you can at the best rate you can. And in the future, you can lower your rate while your property goes up in value. If you're looking for my advice today, it's time to buy. Be smart. Do your due diligence. Don't rush into anything. Buy good properties near the median value in any city. That's where the best deals are going to be. Again, this is in my opinion. Those are my thoughts on the Fed raising rates yesterday, guys, and kind of what it means going forward and what we should be doing as investors. As always, guys, consult your tax CPA, consultant attorney. Look, what I'm doing is I'm telling you what I want to do. Is it advice? Sure, it's advice based on if you're an investor like me, but always, always, always do your own due diligence. Make sure you have a good professional around you. You have good people to get sound advice from. And if I can ever help, please reach out to me. You can reach me in the comments, like the video, subscribe to our channel. I'm trying to put out good content for you guys. Let me know what I can do to help you. Until we talk again, guys, commit to the grind. We'll see you.